Your home is not just a home anymore. It is Wall Street's financial playground. And in this video, we're going to talk about how the real estate game has been changing. And it's been moving from shelter to a financial product. And how I don't believe this is good for society. I'm not quite sure how to stop it. See, the American dream usually goes something like this. I got married to my amazing wife, Sarah. We scraped our pennies together. We saved. We went and bought our first home. And it was on this cute little corner lot. And it was 4 bedrooms and 2.5 baths and a little green belt behind it. And we were able to do that because we were able to save the money, have the credit, and qualify. But it was also easier to buy a home in the early 2000s when I purchased my first home. And today the cards are starting to get really stacked against you. So let's talk about that, because the US housing system is no longer just about shelter. It's about securities. It's about hedge funds. It's about Wall Street. It's about price per earnings ratio and limiting or preventing systemic risks like the great financial crisis. My goal by the end of this video is to help you understand the rules of the game, who's controlling the game, how we got here, and what's happening next. If you enjoy our videos about real estate, hit that magic subscribe button, give it a thumbs up, share this with someone else that needs to hear this, because we love delivering content like this to you, our subscribers, and we just want more of you to come along on the journey. Number one, the shift from a home as shelter to financial products. Understand that shelter is one of our basic human needs, and that's how housing originally started. And unfortunately, today they're starting to get traded like stocks. People are worried. What direction is the market going? When should I be getting in? When should I be getting out? How do I properly time my purchase? They're using big data. We use it. Go find the absolute best investments that we should be putting our money in. So it's becoming like the stock market. And understand the scale of residential real estate here in the United States. We're talking 31 trillion. Globally, real estate is 60% of all assets. So when houses are worth more on a spreadsheet or to the hedge fund or to Wall Street, what do you think it is? It's now worth more to them than a home, and you know the system is changing. Number two, how did we get here? What was the history behind this? Understand that prior to the 1930s, that most of the mortgages in the United States were local, they were short-term, they were 50% down. During the Great Depression, President Roosevelt, as part of his New Deal in 1938, created Fannie Mae to expand the secondary mortgage market. That's where this all started. And originally, Fannie Mae was just there to do FHA and VA loans. But what happened is then they were next pushed into the secondary market. And that basically happened in 1970 when Fannie Mae was authorized to purchase conventional loans. And in that same year, Freddie Mac was created by Congress to introduce competition and improve the secondary mortgage market. So what happened is all of a sudden you've got Fannie and Freddie, which are government-sponsored entities, and they are purchasing mortgages from lenders. They're pooling them together into what is called mortgage-backed securities, and then selling those mortgage-backed securities off to investors, which created massive liquidity inside the housing market for both the bank and for the actual buyer, which lowered interest rates overall that the consumer was receiving. And understand, when the government starts to get involved in anything, it starts to force the prices up. You can see prices start to increase at a faster rate than previously. Government intervention in any product causes it to get more expensive. And so the government didn't just regulate housing, they actually built a giant financial machine behind it to power it. And part of this architecture was they invented the 30-year fixed mortgage. That's unique to the United States. Throughout the rest of the world, they don't have 30-year fixed debt. Then when we go through times where interest rates are really low, like post-COVID, the people who own real estate are able to lock in long-term cheap fixed debt. And that long-term cheap fixed debt starts to function like an asset. But while the consumer is doing it, guess what? Wall Street and hedge funds can also do it too. Guess what? They can borrow more than you. Guess what? They can borrow it cheaper than you. Let's go deeper into the mortgage-backed securities engine. Understand that MBS's mortgage-backed securities, what they did was they decoupled lending from investing. This allows Bank of America, all your big box banks, it allows your large mortgage originators like United Home Mortgage. It allows them to issue, for conversation's sake, $10 million worth of loans that week. They take $10 million on a line of credit and they give it to Bob and Betty Smith and the Johnson friends, and whomever else in $200, $500, $600,000 increments. They run that line of credit up. Once those loans are out and originated, they then package those up and turn around and sell them all to Fannie and Freddie. There is what's called agency versus non-agency, and one is really safe and the other one is risky. The problem is the non-agency mortgage-backed securities, that was what was the freaking jet fuel for the 2008 meltdown and the great financial crisis. How did that really happen? That happened because politicians, both Democrat and Republican, they're both to blame on this, really leaned on Fannie and Freddie and asked them to start promoting homeownership at a higher level. And so what they did was they relaxed their criteria into Alt-A and Subprime, aka non-agency mortgage-backed securities. As we know today, that led to the great financial crisis. So post-great financial crisis, we're now dominated by just your traditional agency mortgage-backed securities. Understand the securitization of mortgage-backed securities made the credit flow like freaking water. But that was the same flood that drowned us in 2008. So we always have to be careful of the speed at which we are doing it and make sure we have good underwriting criteria that is supporting a long, stable system. But the question is as these products keep getting juiced and they keep coming out with more, what is Wall Street doing in the background? The two main pillars that are supporting this are Fannie Mae and Freddie Mac. Their role is liquidity and stability. But understand, when the great financial crisis happened, the government had to step in and basically guarantee each one of them for $200 billion each. Why? It wasn't in their charter, but it was an implicit guarantee. So the government stepped in, pulled them into conservatorship, and that's still not resolved today. So understand that Wall Street said they were private, but taxpayers then footed the bill when they collapsed. Now, I got to be intellectually honest here with the data. The Treasury has recouped $250 billion of the approximate $190 billion that they lent out, but they're still under conservatorship today, and there's push to get them out. On a podcast that we just recorded, we go a lot deeper into the subject on whether they should be private or public or some combination of the above. We'll put a link to that video at the end of this video and in the description below. The new guard is now here though, the institutional investors. We're talking hedge funds and private equity firms buying up single family homes. They own approximately 2 to 4% of all US housing. Now, it doesn't sound like a lot, but in some counties, it accounts for 20 to 50% of the market. Now, that is mostly in the Midwest and in the South. But understand, a family can't compete in that area with an all-cash offer. A first-time homebuyer can't come in who's getting an FHA loan with 3.5% down, make an offer, and someone's going to make an all-cash offer and expect to get theirs accepted. So when the family goes up against Blackstone with billions, I need you to guess who wins here. What this is causing major pushback. There have been bills that have been proposed by Congress about keeping hedge funds out of housing. And I agree with this on the large scale. So in other words, you kind of have to define, do they own more than 100 homes, more than 1,000 homes? But the small ma and pa investor really owns on average between like 1 to 9 properties. We need to allow the small ma and pa investor to continue to build wealth in real estate because it's a phenomenal vehicle, but we do need to prevent hedge funds from destroying whole neighborhoods. The U.S. consumer has been the absolute major beneficiary of, though, the creation of this amazing financial system we have here in the United States. It's increased efficiency and liquidity at a major level. It's given more access to credit to more individuals than we had prior to this. It's created a large, diverse portfolio of different housing types and different product types across the United States. And you can see that real estate is always a good hedge against inflation. The U.S. mortgage system is really the backbone of the global financial system. It's one of the main parts of the plumbing. That's why during the great financial crisis, when we fell apart, we took out the rest of the world. But what concerns me is the financialization of this massive credit market at the end of the day is going to hurt the consumer more and help Wall Street and the big banks and keep pushing that wealth gap. We have to create ways for first-time home buyers, for builders to create affordable products so first-time home buyers can buy them. Because this goes to one of our final points, the costs of what's happening here, the systemic risk and the affordability crisis. The borrower-lender relationship is now broken. Yes, it's very efficient. Yes, the consumer is getting more money, but what's happening is all of that risk from those loans is really being pushed to the taxpayer through Fannie and Freddie. And what that's doing is that's creating housing as a commodity and further promoting this affordability crisis, which is causing the percentage of first-time home buyers to go down and the average age of the first-time home buyer to massively shoot up. So now it's almost 40 years old. And then on the other side, you're seeing rents shoot up. So how can we solve this problem? One, if you care about housing affordability, you need to understand how our system works because it's not going away. It's simply scaling larger. Two, we need to incentivize builders to build smaller homes. And yes, I am talking tax credits. I'm talking lowering permit fees. I'm talking lowering timelines. Because when you build a home, about 24% of the cost of a home is the red tape associated in that market. Why are builders not building starter homes? It's not just greed. It's just actually not affordable. There's not a profit margin that's left there. We have to keep Wall Street out of owning whole subdivisions and preventing that first-time home buyer from entering the market. We have to build more. We are 4 million to 6 million units behind here in the United States. We have to build more. If there was more supply with the amount of demand you have, prices would stabilize or maybe even slightly go down. That needs to be scaled to a higher level. Let's keep Wall Street out. Let's figure out how to get more first-time home buyers into homes. Let's keep rents affordable and let's cut some of the red tape so everyone has an opportunity for the American dream. I'm Anton Stetner. Drop your comments below or questions below. Hit that subscribe button and thanks for hanging out with us.